All right, guys, welcome back to video number 9 of 11 of the options education module. And this is another video that you're going to want to buckle up on because this is a huge introduction to using all the options that we talked about and actually combining two options together, right? They're called multi-leg options. So for instance, say I buy a call and sell a call. What does that do? Like what if I sell a call and buy a put for different strikes? How does that work, right? So we're going to actually visualize this on Robinhood. But first of all, vertical spreads, okay? Vertical means, okay, up and down, right? Spreads, okay? Spreads implies two options, okay? Because they're spread across vertical, right? So essentially, if we go to SPY, load up here. We had a very good day today, so super pumped about that. But if we go to SPY and go into options, so here's what I mean with vertical, okay? Say I got a month or so, and we'll just demonstrate with calls. So let's make our first spread, which is a debit spread, okay? And this is a multi-leg vertical spread, and it goes a little something like this. I'll explain. So to make a debit spread with a call, we need to make sure that we are paying for the contract, right? So I need to be buying something that's closer or more in the money than the one I'm selling. And notice how I bought this one and sold this one for the same expiration, okay? And they're both calls. This is called a call debit spread. It'll come up here on Robinhood. It'll auto-populate it. And it has a risk to reward like this, okay? In 30 days, at expiration, if SPY is above the short strike, we get to keep all of the potential profit. And if it is below the long strike, we keep nothing. We lose the debit, okay? The debit that we pay. And as you can see, total cost to put this on is the difference between the buying of the option contract and the selling, okay? So when we're making a call credit spread, which is a vertical spread on the same expiration date, here's how we understand the risk, right? Besides just like looking at the chart, we need to determine the difference in strike and the difference in premium, okay? So it's a max reward of the difference in strike minus the debit, okay? So watch, the difference in strike is $1 and the debit is 59 cents, right? So $59 because we multiply by 100 and we get $41 risk to reward, right? We can always change this, right? So say I buy the 664 and I sell the 667, right? This is going to be a difference of $3 and we're going to be profiting, right? So the potential profit is going to be the difference in strike minus the difference in the premium, right? So now you have a little bit of a different look. Now it's going to be more of a debit because the difference in strike is larger, okay? So to kind of, simplify this, here's what we have, right? We're buying a call and we're selling a call, right? And you could think of this as like buying a call outright, like, okay, like calls are bullish, right? It's like, yes, so a call debit spread is bullish, right? Now, we need to really think here about what we're doing, right? So I'm buying an out of the money call in this example, right? So this can be bullish in nature, has a 49 delta, 49% chance of expiring in the money. And with that delta, the option is going to move up like this, right? Now, we're shorting this, right? So we're shorting this, call right here, which has a delta of this. So with every dollar the stock goes up, we're going to be profiting on this strategy, the difference in the delta, right? And then at expiration, wherever the stock is, if we haven't sold off the options, is how our risk to reward is going to play out, right? So you can think about essentially subtracting the difference of delta and theta to kind of understand how this spread is going to perform, right? So I have the difference in delta, the difference in theta. So you could say every day that this stock remains out of the money, or, the long call and short call are out of the money, the theta is going to be this and the difference of this, right? So it's like $1 of theta, right? So it's not terribly hard to explain, but essentially we are just creating a risk-defined reward strategy, right? Inherent risk to reward. It doesn't look like, say, this, where you have unlimited gain and you're risking this, right? It's worth noting that, again, you're paying a debit, not receiving a credit, because the long option has more premium as it's closer to here. Now, why can we actually sell a call without having, having the shares, right? Like I thought, okay, Henry, I thought we have to sell our shares, right? If we get a sign on this call. Well, we can actually use this in the money call to exercise against this, right? If that was ever going to occur, right? So say this goes in the money, we're assigned on this, we exercise this, okay? And that's how the risk to reward is defined, okay? When you have a more in the money option, you can exercise it against that, because there's no way that this one can be out of the money and this one could be in the money, right? They're either both in there or they're both out, or one is in, right? Same thing with puts as well. Again, this is very confusing probably, so feel free to watch it over. I'll try to explain with puts again. Again, vertical spread. And we're still making a debit spread here. It's just with puts. So this put is going to be, if we're buying a put, we want this closer to the money. And we want to sell a put that's more out of the money. And we see we have that still risk to reward strategy that we're paying a cost for, right? So define risk, define reward. Now with credit spreads, this is where we switch it up. Okay, so we're going to go back to calls for sake of example. And now we will make a call credit spread, okay? So think about when we're running the wheel strategy, when we're selling calls, we're selling puts, we want to receive income, right? So what does that mean? We're receiving a credit. So what if we were going to sell, say, this option and buy one that's further out of the money, right? Because we're short this one and long this one, so we're going to receive a credit, right? Yeah, a credit for a call credit spread. Now this looks like a debit put spread, right? This looks bearish, okay? This is more so not for those directional bets, but for bets you have that the stock is going to either go down or kind of remain sideways. Because if you think, I can actually go way up here to like a 20 delta and buy the one right next to it. And we have a defined risk, right? We're risking, $77 to make 23. And you can always set this up differently, right? Where you go closer to the money, you receive more of a premium, right? Changes up the risk to reward, but also changing the width of the legs. If I make a $5 spread, is going to change the risk to reward and the total upfront cost as well. So it's kind of just playing around. The kind of fundamentals to a credit spread, both a put credit spread and a call credit spread, is that you have a max risk of the difference in strike, right? So for this, it's a $5 difference. That's your max risk minus the premium received from the difference, okay? Which is why here I can only lose this much because I'm getting this money regardless, right? Because it's a credit that I'm receiving. These are not as directionally biased, right? It's more so to have them be either bearish or slightly bullish. It's also worth noting that, think about this. So we have a short call right here, right? If we finish here at 667, we're short this option. Well, where are those shares coming from? That's when you close out the option before market close, right? So you're not assigned on those. And Robinhood actually does that for you because it understands that there is unlimited risk. Now, if it's way up here, doesn't matter. You can always just lose out on the $500, which is the difference between the legs. And for sake of example, we will do this on the put side. So if I sell a put that is closer to current price and buy one that is farther out of the money, we do a $5 spread. You can see that is the same fundamentals, slightly bullish, but you can be a little bit wrong. Now, I'm going to throw you guys a little bit of a curveball and say, what if I think the stock is going to be range bound? Well, you can make a four-legged option strategy. So say I wanted to say SPY is going to stay between 680, and I can make this here. And it's also going to stay above 640. We have made an iron condor, which looks like this. It looks really, really cool. And this is a strategy that's saying, okay, as long as it stays in between here, we are profiting. It's really quite neat. I usually never put these on, but they're very interesting. And it's just two credit spreads together. You can also do this with two debit spreads if you think that there's going to be, a ton of volatility. So say I did something like this. You can see that there's a ton of risk in this situation, right? Because this is more so if you think that there's going to be a huge move in the stock price where you're taking a bet like that. But honestly, that's up to you. I mainly focus on spreads if I was ever going to do, some multi-legs. But, in a sense of like why to use spreads, you can get a directional bias for a fraction of the price, right? So say I'm bullish on SPY and I want to buy a call for even like 90 days out that's at the money, which is fine to do, right? This is a new expiration, so I'll go here. Maybe just like right around at the money, buy a call like this. You can see that it's definitely unfavorable in the amount of cost we have. So what if I was going to say, okay, I think it's going to be above 660 or 655, but maybe we get to like 685. I've made a defined risk strategy where I'm only putting up now 1,700 instead of 272, right? So again, almost $3,000 compared to, again, if I go 680, you're making a defined risk reward. So you can finance some of your bets with those. So that's kind of it. I know I didn't go like as into depth as I usually do, or maybe you thought I did. I typically don't run these style of option, multi-legs. I personally just don't love them for my personal strategy, but again, comment if you have any questions and I'll address them. But again, we learned about the debit and credit spread as well as an iron condor. I would be more gung-ho dork. It's credit spread, but that is up to you. And we will be in the next video finishing off the last module. Pretty crazy, but I'm glad you guys have stuck around. And I will see you in the next video.